Welcome back to the Keiser Report. I'm Max Keiser. Time now to go to Egon von Greyerz of goldswitzerland.com. Time for our Egon sanity check. Egon, welcome back.
Thank you, Max. Good to see you.
Now, it's been 50 years of fiat money, going back to August 15th of 1971 when President Nixon closed the gold window and this whole fiat money began. So how significant is the Nixon shock in terms of monetary history? What is it? Why did it happen? And what happens next, Egon?
Because we live today, we think it was extremely significant as something that it's changed the world totally. But, I always go back to history. I mean, this has happened every 50 years, 100 years throughout history. As long as there's been some kind of money, fiat money, precious metal money, silver money, gold money, the governments always have to cheat and debase that money one way or another. With the denarius in the Roman during the Roman Empire, it went from 100% silver content to zero silver content over a 100-year period. So it really is inevitable that every single 50 to 100 or every 50 to 100 years it has to happen. So Nixon, we can blame Nixon. It was his fault, and his fault that we are in a mess now. At the same time, it's happened every so often in history, so it had to happen. So he was just a messenger, and basically we'll blame him for it, but it would have happened anyway, because no government can live with without printing money, because otherwise, if they can't print money, they can't actually buy votes, and that's the way that they rule the world, unfortunately.
Right. So let's talk about inflation here for a moment, because this money printing, going back 50 years, it's been ramping up for decades, and it's gone hyperbolic in the last decade. We haven't seen top-line inflation so much until recently. So there's two schools of thought. One, it's transitory, brought on by the COVID virus and some of the externalities that caused. The second school of thought is that it's a structural shift now toward higher inflation based on all this money printing. What's your view?
Well, my view is very clear. We are going to an inflationary period now. Take my word for it. There's absolutely no other way. The disinflationary camp now thinking that we're going to see a period of low inflation, low interest rates. That ain't going to happen. So I'm seeing now that's going to be the shock to the world. I'm seeing bond yields going up dramatically. I'm seeing not the inflation. We're seeing inflation in every area of markets now. We're seeing it in food prices. We're seeing it in shortages in all kinds of goods and services. We are going to get, and remember, I was there in the 70s. I was in the UK, which was a good place to experience real inflation. And I saw inflation going to an average of 50, average was 15% for 7-8 years, and it was up to 25%. And the currency collapsed, of course. So I've seen it happening, and we're going to see it exactly the same now. We're going to see wage inflation. Food prices will continue to surge. And of course, the effect, as we all know, will be the major effect. Of course, it'll be markets going down, but it'll be in the currency also. That's always the effect of inflation and money printing. Now, since I lived in the UK, I looked at the inflation figures, what was called in the UK, the retail price index, from 1800 to 1971. And on average, it was 1% inflation a year. That is a typical inflation throughout history. People think that it's normal now that share prices double every few years and house prices double every so many years, 10 years or whatever it's been lately, 10, 15 years. So, but that is not typical. Typical is what I just said. From 1800 to 1971, 171 years, that was average 1% inflation. I didn't look at exactly the same figures for the US, but I'm sure they'll be the same. So from 71 to today, it's been 6% average. So we've gone from 1 to 6. And of course, with 1% inflation, prices go up double every 70 plus years. And with 6% in inflation, they double every 13 years. And that's what we've seen now. And seeing now that is not typical in history, but we are going to go into now inflation escalating, and it's going to become exponential at some point. And the interesting thing is the bond market will be, of course, giving us the signs. And the Fed will not need to buy bonds anymore at some point in the next year or two, because the whole market will buy bonds. They will get out of stocks and they will buy bonds, because that's the only way they think they should protect themselves. Few of them realize that they should buy gold instead, but that will also be, that would be a major bull market in gold, or a debasement of the currencies, as happens every time in history in these situations.
Right. You talk about historically inflation's run at 1% and 1.5%, and we're in an unusual period. You know, one of the historical impacts, inflationary impacts, would be technological advancement, and certainly the Industrial Revolution. You know, you talk about England brought on cheap, mass-produced plates, dishware, soap, underwear, you know. So prices for these things actually went down a lot, and that was a mitigating factor to the inflation. How is it that we're in a technological age, the information age, which is supposed to be as significant as the industrial age, and we're into this technological boom of apps, of Uber, Amazon, you know, all these things happening with our cell phone? And so that should be deflationary. And yet we see prices going up despite that. Is that a testament to how reckless the central banks are, Egon?
Well, of course they are. And, you know, inflation, as we both know, does not arise from prices going up or disinflation. From technology will have play a certain role, but inflation arises primarily from debasement of currencies. And if you print worthless money, you basically cannot avoid debasing the currencies, and therefore automatically you create inflation. Every event of hyperinflation in history, and it happens regularly, as I just said, and it's going to happen again. This time it will be on the global scale. It never has been before. Before it was only a region or a country, and now there'll be the whole world. And every event has always happened because of the debasement of the currencies. So, you know, I don't see anything different now, and that's what we will see. And never mind, you know, as Nixon said, we temporarily will suspend the backing of the dollar with gold, and here we are 50 years later. And we are seeing rampant inflation now, and it's just starting. It's going to be vicious. It's going to be very vicious in the coming years. And it's going to be shock. It's going to be a shock to markets, because markets don't expect inflation. Bond markets don't expect inflation. They're seeing it coming. We're seeing all the signs, but nobody wants to believe it. Central banks are going to keep rates down. Absolute nonsense. They're not going to succeed in that, and in the end, they will actually be forced after the event to raise rates, as they always have.
All right. Well, okay. Let's talk about this for a second. So the technology has been huge, the technological advances, and the money printing's been also huge. I get what your point is, that it's a money printing phenomenon, and the technology track is not necessarily the contributing factor. However, the stock market's hitting new all-time high are from people buying tech stocks not because of the money printing, but because of all the economies of scale that come with the technology. And it seems like they have deluded themselves. In other words, they believe they're buying these stocks at all-time highs because they believe the growth story at 60 times earnings. But they don't see, actually, the reason they're buying them is that they're front-running the central bank. And they never admit that. What are your thoughts?
It's always the same, Max. It's always the same. You remember the Nikkei, the Japanese stock market at the end of the 80s, going up to 40,000, and you read all the reports from the brokers and the analysts that this is just the beginning, and we're going to see this going on forever. And the market, of course, crashed totally. Down from 40,000, eventually down to 10,000, roughly. We both remember, not very far away, NASDAQ in 1999, 2000. So, in a short period of time, in the last year, it doubled. And then it went down 80%, and that was tech stocks. So there was exactly the same phenomenon as now. So, but as we say, plus ça change, plus la même chose. the more things change, the more they stay the same. It's going to be exactly the same as before. These tech stocks are going to collapse and the valuations will come down dramatically.
Right. Now, you recently tweeted, quote, "There's no strong dollar, there's no strong euro. The currencies are all ephemeral blips in history that are destined to become extinct the day they are born." Now, you have history on your side, Egon, right? I don't think there's any fiat money that's ever lasted, ever in 300 years, or lost 99% of its purchasing power, Egon.
Yeah, there is still one currency in the world that's been around for a while, and that is the pound, the UK pound. It's been around since the late 1600s, but at that time, 1 pound bought, I think it was 12 ounces of silver. Today, 1 British pound buy 1/20th of an ounce of silver. So although the currency in name has survived, in reality, it's become worthless since, like every other currency. So, and that is the only currency in history that is still there by name, but by value certainly not. So, it's so easy. This game is so easy because it happens over and over again in history. And it's sad to see that all of these investors and analysts and governments, they have no interest in history. It's always different today because they live today. History tells us otherwise.
Right. We're going to have you for a second segment, and we've got about a minute left in this segment. So a quick question. I mean, you've got your fund over there, Gold Switzerland, and we look at all the money management in the world, about 1% invested in gold. What are the trends? Are people starting to wake up to this and then see that gold thing move up, or they haven't had the day of reckoning yet? We've got about 45 seconds.
Okay, let me correct you. We don't have a fund. We assist high net worth individuals to preserve their wealth by holding physical gold in their own name. So we are a facilitator. We're not running money as such. And yes, if you're talking about right today, gold demand is very slow today. Refiners are not very busy. But if you're looking at people moving out of the banking system, wealthy people, we're seeing that all the time. We're seeing money moving from the banking system to the private vaults that we offer to clients. So that move is continuous. The gold buying is not there right now in any major quantities. That's going to come, and that's going to come in a big way.
All right, Egon, got to go. We'll hold another segment shortly, and thanks for being on Keiser Report.
Thank you, Max. Always good to talk to you. Thank you.
All right, and that's going to do it for this edition of Keiser Report with me, Max Keiser, and Stacey Herbert. I'd like to thank our guest, Egon von Greyerz of goldswitzerland.com, a vaulting service. Until next time, bye, y'all.